This explainer is for educational purposes only and is not financial advice. Please always do your own research or consult a licensed financial professional.
All right, let's jump right in. We're going to be navigating a market that feels like it's really at a crossroads. We're getting some seriously mixed signals from the Fed. The major stock indexes are sitting right at their all-time highs. And, there are some fascinating splits happening in key sectors like tech and crypto. So let's try to make sense of it all. First up, let's talk about the Federal Reserve. They just sent a message to the markets that was, well, confusing, to say the least. See, on one hand, they cut interest rates, which you'd think is great news, right? But when you dig into the details, it tells a totally different story. So much so that people are actually calling it a hawkish cut. I mean, what does that even mean? Well, this chart here really captures that contradiction perfectly. You hear these terms dovish and hawkish all the time. Just think of dovish as being kind of soft and optimistic, pro-growth, like a gentle dove. Hawkish, on the other hand, is way more aggressive and cautious, like a hawk circling, looking for inflation. So the Fed chair's language was super dovish, very optimistic, but their actual projections, the dot plot that shows where they think rates are headed, were much more hawkish. They're signaling fewer rate cuts than the market was hoping for. It's a huge reminder to watch what they do, not just what they say. And then there was this statement, "We will deliver 2% inflation." You almost never hear a central banker talk with this kind of absolute certainty. So why is this such a big deal? Well, while the market loves certainty, this level of conviction it's just plain weird. It can mean there's a real change in their strategy, or, as some people are guessing, it might just be a sign that the current leadership is on its way out and feels like it can speak a little more freely. Okay, so with that confusing message from the Fed in our back pocket, let's zoom out and look at the broader market. Because really, everyone is asking the exact same thing. After such a huge run-up, what on earth happens next? And this is where we are right now. The S&P 500, which is a key benchmark for the whole U.S. stock market, is right back near its all-time high. I mean, think about that. Despite all the fear, all the volatility, we've climbed all the way back to the summit. So this leads us to the million-dollar question on every investor's mind. What is the next move? Is all the good news already baked into the price? Or is there another catalyst out there that could push us even higher? And on the flip side, what are the big risks that could finally trigger a pullback? So the case for more upside, the bullish case, really rests on a few key things. Corporate earnings are looking solid, the economy is still expected to grow, and central banks all over the world are basically pumping more liquidity into the system. That last point is really, really important. You can see it in something called M2, which is just a measure of the money supply. When M2 is going up, it means there's more cash sloshing around. And historically, a lot of that cash ends up in assets like stocks. But, it's not all sunny skies. You'll hear the word frothy getting thrown around a lot, which is just a fancy way of saying prices might have gotten a little ahead of themselves. Some analysts are even calling for a 10 to 20% pullback next year. And here's a little technical warning sign. This recent rally, it's happened on pretty low trading volume. That can be a red flag, because it might suggest there isn't a ton of strong belief behind this move up. Now let's really narrow our focus and zoom in on the tech sector, because this whole AI revolution is creating a fascinating split between the winners and the losers, and it's all happening right in front of us. This table here tells the story perfectly. Okay, so first, look at Oracle, an old-school tech giant now facing real concerns about its debt and whether it can even keep up in the AI race. That news actually put a little pressure on the AI darling NVIDIA, though, let's be honest, most people still see it as a long-term leader. Then you've got a totally different story with Netflix, where talk of a potential acquisition has some investors sniffing around for a value opportunity. And finally, you have Adobe, which is trying to embrace the change by building AI right into its software. A smart move for sure, but maybe a slow one. All right, last but definitely not least, let's turn to the wild world of crypto. The recent volatility has really shined a spotlight on two very different strategies for investors who are trying to navigate these massive price swings. And it really does boil down to two main camps, as you can see right here. On the left, you've got the active traders. These are the folks glued to the charts, using technical signals like the 50-day moving average to try and time their buys and sells. They're trying to buy the dip and sell the rip to make some quick profits. Then on the right, you've got the long-term investors. They're not trying to time anything at all. Their strategy is dollar cost averaging, just investing a set amount on a regular basis, no matter if the price is up or down. They're just holding on through all the crazy swings, betting on the next big cycle. Thanks for watching this video overview on 15-Minute Investor.